This is Lecture 7. It's on bonds. This is also Chapter 7 out of your textbook if you want to read along. Here's a quick outline of what we're going to cover. We'll start with some definitions, and then we'll get into some quantitative stuff. So for starters, what's a bond? Basic definition. It's a debt security. It's debt, which means it's borrowed money. You have to pay it back. It's a security in that it's a tradable instrument. So it's a borrowed money that you've issued a piece of paper that then trades in the secondary markets. Most debt securities, bonds, trade on OTC, over-the-counter markets. But that doesn't necessarily mean they're not liquid. It depends on the bond. Some bonds do have fairly liquid markets, but they just don't have big public exchanges like stock exchanges. They tend to have individual market makers for each security that your broker would have to go through a network to find the right buyer, kind of thing. Bonds have predetermined principal and interest payments. That just means that all their cash flows are set out in advance usually. Sometimes you have variable interest rates and things like that, but there's a set rule as to what that interest rate's going to be in the future. Principal is just the amount you borrowed. That's how much you have to pay back. And then interest is your cost of funds. It's interest rate, and we talked about interest rates in the last chapter, but it's your cost of money. It's how much you have to pay as a percent each year. Let's look at key features of bonds for starters. There's 5 key features here, and we're actually going to tie these up with your 5 key time value money variables later. But for starters, par value. That is what we call the principal amount, or the amount you borrowed. It's also the amount you have to pay back when the bond matures. Bonds have a fixed life, and when they mature, which is called the maturity date, the next one, you usually have to pay back $1,000 per bond if you're the issuer of the bonds. So if you issue 1,000 bonds, that means you might not have necessarily raised 100,000. We'll talk about that in a second, but you'll have to pay back 100,000 upon the maturity date. The coupon rate determines your periodic interest payment you'll have to pay. Coupon rate's also sometimes called the stated rate because it's fixed. It's stated on the bond. It used to be that if you bought a bond, you'd actually get a certificate that had certain things written on it. And all 3 of these first things, par value, maturity date, coupon rate, those would be written right on the bond. So they're fixed. They don't change. The next 2, yield, maturity, price, those change over time. They're called coupon rate because it used to be every time you wanted an interest payment, you'd have to tear off a little coupon. They had these little perforated coupons on the bottom of your bond, and you'd have to tear them off, mail them in, and then they'd mail you back your coupon payment. Nowadays, obviously, none of that. It's all done electronically. In fact, you never even get a bond anymore. Your broker usually holds it on your behalf, and it's all kind of done electronically. So, but it's still called a coupon rate. In order to determine how much you're going to get paid each coupon payment, you take the par value, which is usually 1,000 again, and you multiply it by the coupon rate, but you got to divide by the number of payments per year. So if it's 1 payment per year, let's say it's $1,000 par value and a 10% coupon rate and 1 payment per year. 10% of 1,000 is $100, so you're going to get $100 once a year. Most bonds actually pay semi-annually, which is twice a year. And so for those, you need to divide that coupon rate by 2 to get how much interest you're receiving every 6 months, and then you multiply it by the par value. So if it was 10% coupon, $1,000 par, 2 payments a year, you'd be getting $50 a year twice a year. The next 2 key features are the yield to maturity. The yield to maturity is the interest rate that you're actually going to earn if you buy this bond. Just because it has a 10% coupon rate, say for example, doesn't mean you're actually going to earn 10% on that bond, because you may be paying a premium or a discount for the bond. If the bond sells right at par, which is it sells right at 1,000, then you're going to receive the coupon rate as your yield to maturity. They'll be the same. But if you pay a premium for that bond, meaning you pay more than 1,000 for it, and bond prices trade in the marketplace just like stocks or oil or wheat or any other commodity or any other secondary market security or asset, their price fluctuates every day. So the price could go up, could go down. Par value is fixed to 1,000, but the actual price, which again is another one of our key features to the last variable, that varies day to day, and as that varies, the yield to maturity varies. And we'll see the dynamics between if price goes up, what happens to the yield to maturity, and if the market pushes the price down, what happens to the yield to maturity. But what you actually earn on the bond is not necessarily the same as the coupon rate. In fact, it rarely is. Alright, let's move on and look at some other features of bonds. Still important, but these are sort of optional features. Not all bonds will have them. Some bonds will, some bonds won't. Those first 5 features we looked at, all bonds have those 5 features. But for starters, an indenture is a legal document that outlines all the different legal underpinnings of a bond issue. There's all kinds of different things that could go into an indenture, so this is just a small subset. But some common things that might be outlined in an indenture, which it just takes that basic bond issue and says these are all the little legal ties that you have to consider. For example, collateral. A lot of bonds, when they're issued, they have certain assets that are tied to them. So they issue the bonds to raise a certain amount of money, and then they have to take that money and spend it on certain assets. And then those assets are used as collateral. So in the case that the bonds default and can't pay off, the bondholders can come in and sue and actually sell off those specific assets to get their money back. Bonds can be as complex legally as you want them to be, as opposed to, say, stock, common stock, for example, which is very legally non-complex. Stock, you basically have no collateral or any of these other features. You just get money. If the company happens to have money left over after they've paid all their other stakeholders, you get some money, otherwise you don't. That's it. That's really your only legal right. As a bondholder, when you buy the debt, you can choose to create any kind of legal restrictions on the company you want. So collateral is one of them. Call and put features are another example. If a bond has a call feature, that gives the bond issuer the right to buy the bonds back at a set price. At some set date in the future. There's usually a time limit. A lot of times those calls expire relatively quickly within the first several years of the bond issue, and they're just to make sure that interest rates don't move in an adverse direction to where they would have. They don't want to accidentally issue a bond at a 10% interest rates and then rates fall to 5%, and then they got 5% too high cost of capital when they could have had 5% lower. And so they put that call feature in there to kind of protect themselves. There's also a put feature, which is much more rare, but put feature allows the bond owner to sell the bond back at a set price in the future. Calls and puts are options. They're types of derivatives. So if you ever take a derivative course, you'll learn about options, calls, and puts. Call and put features in bonds are like a bond tied with that option. So a put feature gives the bondholder the right to sell it back at a set price. It's protection for the bondholder. So if the price falls, there's some floor that the price can't fall below. So say you buy the bond for $1,000 and you got a put in there that says I can always sell it back to the company for $900. And then a year later the price falls to $800 in the marketplace, in the secondary market. Well, you're floored out at $900 because you can always go back and sell it for $900. The call does the opposite for the company. If the price of the bond gets too high, they can put a ceiling on it. So those call and put features just give a little bit of insurance either to the issuer of the bond or the buyer of the bond. A sinking fund provision is put in there to ensure that the company doesn't get stuck with one large bill due at the end of the bond. On maturity date, they have to pay the whole amount of the bond back all at once. Companies can usually get away with that, large firms, because they can just go out and issue more debt to pay off old debt. But if you're a smaller firm, investors aren't going to trust that you're going to be able to go out and raise more money to pay off your old debt. So what they want you to do is pay off your debt over time, which means each year put a little money down to pay off that bond issue so you don't get stuck with that $1,000 par value per bond at the end that you have to pay off all at once. And that's what a sinking fund is. It's a requirement that the firm put a little bit of money into paying off the debt or actually buying back a certain amount of bonds. But usually they just have to set a fund aside that they put a little money into each period, and so they when it comes time to actually mature the bonds and pay off all the bonds, they have the money because they've been paying it in there over time, as opposed to have to come up with the money all at once. Conversion feature. some bonds are what are called convertible, which means they can be converted into shares of common stock at a set ratio. So it might be you get 10 shares of stock per bond or something like that. They usually set it up so that when the bond's first issued, there's no reason you would want to convert. You'd be taking a loss. You might be converting $1,000 worth of bonds into $800 worth of stock, so you'd never do that. But what happens if the stock price takes off? If the company does really, really well, the stock price will go way up. We'll talk about stock in the next couple chapters, 2 chapters down the road. But stock has the potential to have a really, really high gain. Bonds don't have that. Bonds have set cash flows, so they don't have that benefit that there could be a really, really high positive gain. You usually know your maximum gain because you know exactly what your cash flows are going to be. But this conversion feature can help companies sell bonds if they're in a company that has, for example, a lot of growth potential or something, and they can't find a lot of buyers. What they'll do is they'll make them convertible so that owners know if the company really takes off and the stock price shoots way up, they'll get some of that benefit. Subordination clauses have to do with setting which debt is most senior and junior. So those are just legal. If the company happens to go bankrupt, this determines who gets paid off first, which bondholders. One thing I didn't put in here, which I probably should have, but I'm not going to go back and put it in now, is restrictive covenants. Within these indentures, there can be all kinds of restrictive covenants, which are restrictions on what management of the firm is allowed to do. So if you're going to buy their debt, you might require that they keep a minimum or a maximum debt to equity ratio, so maximum amount of leverage. So if they happen to go over that leverage ratio and take too much leverage, you could sue them and sell off their assets to get your money back. Or you might have a minimum times interest earned ratio, or a minimum current asset or current ratio, or minimum quick ratio. All those ratios we talked about several chapters ago that have to do with the debt ratio and the riskiness of the company, a lot of those things will go into one of these indentures, and they'll say, management, you can't do this, that, or that, or the other. You have to make sure you say a certain amount of safe, not risky. And then really you can put absolutely anything into one of these. So you can restrict that the company can't pay out a certain amount of dividends, that they can't take over another company, can't merge with another company, all kinds of things. Really, there's no limit to what you can put in an indenture. It's a very flexible agreement between the bond issuer and the bond buyers. Bond issues are usually sold to a set group of investors, unlike common stock, for example, which is sold to the public, which is sold to everybody. Bond issues, usually they're sold to some bond buyer who has a group of lawyers who go through these contracts. I've actually helped several companies do bond issues before, and there's a bargaining process between the lawyers. Basically, it gets into the real nitty-gritty details about what kind of restrictive covenants are they going to restrict management of what they can and can't do. They may restrict, for example, how much the CEO can get paid, things like that. So things the CEO doesn't want to give up control of, he might have to give up control of in order to get the bond issued. All right, we're running a little low on time on this video, so I'm going to stop it here. When we come back, we're going to look at bond pricing.